if you got a family trust with a bucket company, you probably heard people say they are useless now. Well, apparently, Australian government has killed that strategy. So, should you shut yours down if you have one? Well, not so fast. Let's look at what's actually been proposed before you make any of the strategic decisions. Hey, welcome back. I'm Molly, founder of Above Advisory and a certified tax accountant with over 15 years helping business owners legally reduce tax and actually building wealth long term. Before anyone rushes to restructure their business, let's separate the headlines from reality. In this video, I'll explain what the proposal actually is, why everyone's suddenly talking about bucket companies, whether they still have a place in your business structure, and exactly what to do next if you got one. Let's start with what's actually happened. The government has released a proposal that would introduce a minimum of 30% tax in a family trust. Now, your discretionary trusts are one of the most common structures used by Australian small businesses because they offer flexibility in how income is distributed. But with this new proposal, that flexibility takes a big hit. Distributing income to beneficiary on a lower marginal tax rate, say a spouse, your adult child or family member taxed below 30%, will still effectively be taxed at 30% at the trustee level after the budget passed. So let's have a look at what it looks like in reality. Before the budget was proposed, whenever the family trust makes profit or money, you can choose to distribute it to yourself, your spouse, and potentially your adult child. So let's just say if your tax rate is 25% and your spouse is paying 20% tax, and say your adult child hasn't fully worked, so they're probably paying 15% tax. So at this level, whatever the family trust distribution is, most likely you'll pay less than 30% effective tax rate, even among all your family members. If this new budget proposal has passed, what is going to happen is 30% tax initially will be paid by the family trust level, by the trustee company or the family trust. Then only you can choose to distribute to your family members. So in the exact same scenario, let's say your tax rate stays the same, you're paying 25% tax, your spouse is paying 20% tax, and your adult child is 15% tax. It doesn't matter what your marginal tax rate is, because you would pay the 30% tax first initially, you would end up paying at least 30% tax on any trust distribution profit you ended up getting or distributing among your family members. So naturally, when people hear minimum tax and trust in the same sentence, they start asking whether the strategies they have relied on for so many years still actually work. And that's exactly where bucket companies enter into the conversation. A lot of the headlines make it sound like this proposal completely destroys them. But before we can answer that properly, we need to understand what a bucket company actually does. So let's do a quick refresher on it. So let's just use the same example that we were saying before. Once your family trusts make profit, your family trust can distribute to you or your spouse, or if both of you are on high income level, you can also use to distribute it into a bucket company and retain the profits inside this bucket company. Before this new budget proposal, the bucket company potentially might pay 25% tax if you're distributing a business income. And however, with this new budget proposal, after you distribute it to your family members, and let's just say you would like to distribute to a bucket company, instead of just paying 25% tax as it used to be, now your family trust would pay a 30% tax first at the family trust level, and potentially your bucket company would pay additional 25% tax for business income or 30% tax for investment income. Effectively, if you end up using your family trust to distribute into a bucket company post-budget, and once this trust proposal has passed, you would end up paying either 55% to 60% tax for the same income that you used to get, where you probably would end up paying 25% tax effectively. So this is not really a tax loophole. It has been a legitimate part of tax planning for thousands of Australian businesses for better part of over 2 decades. So quick one for the comments. Do you already have a bucket company? Has your accountant mentioned one, or is this your first time that you've heard of it? Let me know in a comment below. I want to know who it actually affects. Now let's look at why bucket companies specifically are affected by this proposal. It's because there are actually 2 changes stacked on top of each other. Like I was saying, because the company doesn't get a credit under the new proposal for the tax that is already paid by the trust level, that same income could effectively be taxed twice. Same dollar, taxed twice. And that's exactly why accountants are paying so much attention to this new proposal. Because one of the biggest advantages of bucket companies traditionally offered is a lower flat tax rate, and you could divert your profit over a long period of time. And now this is going to be significantly less attractive for profit, and because a lot of people will be trying to avoid paying tax twice. So before you go and shut down your bucket company, there are a few things you actually need to know. First, these are still a proposed changes as of today, and even if they become law, they are not proposed to start until 1 July 2028, and there's also proposed rollover relief that could actually allow eligible businesses to restructure without triggering any income tax or capital gains tax. But we don't know much more information on that just yet. Second, bucket companies were not only about reducing tax. They can still play a role in things like asset protection, retaining profits for future investments, and giving businesses flexibility over the long term. And finally, good business structures have never been built around just one tax rule. They're built around your goals, your family situation, and your long-term plan. The tax outcome might change, but that doesn't ultimately mean the structure is wrong. It means the numbers need reviewing, and you probably need to have a strategy conversation with your accountant. So no, bucket companies aren't actually dead overnight. You just need to know how to use them in future. So let's get practical. The biggest mistake right now is doing nothing and hoping it sorts itself out. That just means scrambling in 2028 alongside every other business owner trying to restructure at once. But the opposite mistake is just costly, rushing to change a perfectly good structure before you even check whether these changes actually affect you and your situation. Here's what to actually do instead. Start by getting your structure model against the proposal. Ask your accountant to run your recent trust distributions through the proposed 30% minimum tax and the no credit rule, and show the real dollar impact, not just the vague reassurance. Next, understand who your distributions are actually going to. If most of your trust income is already being distributed to your beneficiaries, just say you, your spouse, and your family member, paying around 30% tax rate, these changes may be very little minimum impact. But if you rely on lower tax family members or bucket company, that impact could be much more bigger for yourself. And finally, keep an eye on how this legislation is going to develop and finalize. Proposals can do change before they actually become law as well. So don't make a permanent decision based on a draft proposal. So let's bring it all together. Have these proposed changes make bucket companies less attractive from tax perspective? Well, potentially yes. The tax benefit that make them popular, being able to retain profits at a lower company tax rate, could look very different if these rules and legislation do get passed. But does that ultimately mean every business should get rid of this? Absolutely not. Bucket companies are still working fine under the current rules, and accountants are suddenly telling every client to close them down, and it's probably going to cost them money and so much administration work and time to close it up if they don't think that they need it. But they also need to be very careful about setting them up. For some businesses, these changes may mean their current structure needs to be reviewed or just adjusted. For others, a bucket company may still have a valuable role beyond just tax. The key takeaway is this: don't ignore the changes, but also don't panic and shut down a structure that may still work for you. You need to get the numbers, understand your opinions, and make decisions based on your circumstances, not based on the media headlines. Let me know in the comment below, has this changed how you're thinking about your own structure, or are you planning to wait and see until the legislation actually get passed? If you found this video helpful, make sure to hit like and subscribe for more practical tax tips in future. See you in the next video. Bye for now.